Good morning, welcome to the Killik Go podcast for Friday the 29th of April. So tough week for markets, and that's principally because of the Bank of Japan left policy unchanged. That was a surprise because we've seen a stronger yen this year, which has been putting pressure on their exports, and we've also seen a contraction in their manufacturing industry this week when that number went down to 48. So this is more evidence that central banks are on hold. And they're trying to pause on the extreme policy we've seen over the last couple of years and also pause on the contradictory policy. So it looks like the Japan economy and the ECB are working in tandem with other central banks. Equally, on the other side of the coin, it looks like the FOMC are not looking to aggressively raise their rates. And so we get less pressure in terms of currencies and volatility on markets, which we think is actually good for markets in general, although clearly the strengthening yen is bad for Japanese exporters at the moment. In emerging markets, we've seen a really strong run for emerging markets in general and economies linked to emerging markets. And this is really because we've seen dollar weakness, and with it, we've seen an improvement in the macro news flow. So here you can see an extremely sharp rebound in the economic surprise index, and that's now at extended levels. So we look at that and we feel that probably the easy money has been made over the last few months, and for emerging markets to continue to positively surprise will be harder from these extended levels. So just keeping an eye on those positions in terms of short-term profit taking. We've also seen this week further evidence of very slow rates of growth in developed markets. So we've got a poor or slightly below consensus GDP number for the US. And the cyclical companies that have been reporting in the results season this week have generally been slightly lackluster. And on the other side of that, we've seen the growth companies coming through with very strong results. So we know Facebook and Amazon this week. So really that's more fuel for our conviction that these growth companies have the capacity to outperform while we're in this low growth environment. So going ahead to next week, on Monday we've got Ferrari, on Tuesday we've got HSBC, Aberdeen Asset Management, Cummings, on Wednesday Royal Dutch, Glencore, eShore, Direct Line, TripAdvisor, Whole Foods, Heidelberg, Continental, Deutsche Telekom, so a very busy day. Thursday BT, Church and Dwight, Merck, and nothing on the Killik list on Friday. So just having a quick look at Ferrari, it's a niche idea, but a very interesting one. So Ferrari we're looking at as a company that can offer bond-like returns with upside. So the bond-like returns come from the incredible visibility that you have over their revenues. So if we go back to 2007 through the great financial crisis, peak to trough, their revenues only fell 4%. And that's because there's an 18-month waiting list for the entry-level Ferrari. So they really do produce less cars than there is demand for. They've also got very limited exposure to the Chinese market. So a lot of the cyclicality that comes from the transition of that economy is not affecting their sales. So as a result, you can have great surety on the revenue line, the cash flow coming through, and we do see really interesting margin potential with this business since the IPO. We also feel that it's outside of that technical disruption debate that leaves us cautious in a lot of auto manufacturers, because it really is about the driving experience with Ferrari. It's not about sort of normal utilitarian transport. So on 20 times with an equity yield of 5%, we actually think this share can re-rate further and should trade at a premium to the luxury goods sector, which is on 22 times, and probably nearer a multiple like a Hermes, which is around 27 times. So that's it from me. Thanks for listening. Have a good weekend.